This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASIC-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing.
Drew Meredith. Owen is still away in Palm Cove. I think Palm Cove.
Port Douglas now.
He's in Port Douglas, is he? Right, yeah.
Decided to move his holiday.
Yeah, just
50 kilometres up the coast.
It's a really nice drive, actually.
When there's not roadworks, but I'm told there's always roadworks on that road.
I hope he stopped in at that Hartley's Crocodile Farm.
Yeah.
That's a lot of fun. That is fun. So, Drew, I've got in front of me the 10 most powerful people in corporate Australia in 2025 from the Fin Review. Released this week. And I want to see how many of the 10 you can guess. I think it's a great little way to start off.
Corporate, I mean, is there overlap? Because I managed to read the tech and the deal makers ones. Is there overlap between them?
I don't know because I haven't read those.
All right.
So we're flying blind here.
Surely Corporate Australia, Joe Longo is on the list.
Oh, let me have a little scroll.
The head of ASIC. Surely. He's setting the direction of this. Are we doing it that way or are you giving me hints?
I'm not giving you anything at the moment. No, I think CEOs essentially.
Right.
So not Joe. Joe, not on the list.
Not on there. I mean, can he go in consulting? Like Paul Howes? I mean, maybe he's left where he was and going somewhere else. No. Right. So
just
stay away from
go
Chairman.
more straight up and down the line.
Richard Goyder.
Jesus. This is going to be a really long episode.
David Gonski.
No.
Vanessa Hudson.
No.
Corporate Australia.
Who would be number one?
BHP's CEO, chairman.
Me. This is...
I don't know. Who's relevant to corporate Australia?
Maybe the CEO of the largest ASX listed company.
Oh, I forgot his name. Young fella. Matt Common.
Yeah, he's the number one.
Most powerful in corporate Australia.
Yeah.
But he just lends to rich people.
Who's the second? Who do you reckon's the second?
Shamara Wickramasinghe.
She's on the list.
There we go.
You're on the list. She's
now.
Number 7.
I'm guessing Nuno's not on there, given what's happening. No. Who's the CEO of Telstra?
Vicky Brady.
Vicky. I thought Vicky.
No, I don't think she's on the
list. Scott. What's his name? Not Don Scott. The guy who runs Wesfarmers.
No, he's not.
This is really hard.
Electric podcasting
Jacob
as well.
Denham,
I'm going to run down the list now. Mark Delaney,
head of Australian Super. I could probably tell you what their roles are if you say the names. Maybe that's better.
Leah Weckett.
No, don't know.
Meg O'Neill.
Woodside.
Yep. Andrew
Fortescue.
John Mullen.
Oh, it used to be Telstra.
He's the chairman of the Chairman's Club.
Oh,
there you go.
Okay.
So
not the Chairman's Lounge, the Chairman's Club.
Shamira. Yep. Ryan Stokes.
Stokesy.
Gina coming in at number 9.
Corporate. Yeah, and
Paul Bassat.
Yeah. Oh, he runs Square Peg and the SEEK part of, or is that Andrew? The VC part of SEEK?
Yes, the VC part.
Yeah. I mean, this seems like corporate Australia and it's just the biggest CEOs and chairs of the biggest companies. But it seems very narrow. You got like 3 iron ore miners.
It's essentially.
I guess that's important because they pay tax.
It's very representative of our
ASX, not of our corporate Australia. There's 1,600 companies in Australia that you can just on the listed market. Surely there's broader representation than 3 banks, 3 resource companies.
And I'm absolutely shocked yourself or Jamie not on this list.
Yeah, particularly Jamie. I mean, I try to fly under the radar.
What else has been going?
Like tech. Someone thought I was in tech the other day at the gym. I'm like, they were like, "Oh, I always thought you were in tech." I'm like, maybe I could be in the tech one next time.
Shackets.
Yeah, and I don't wear the shackets to the gym.
Well,
though.
they see you getting changed and leaving the gym, and
all right. I don't do that either.
Yeah, right. Getting in your Audi.
Just
you probably,
red and black.
You don't drive an Audi. You drive a Prado, don't you?
Yeah. Well, everyone knows.
Everyone knows. Well, clearly, long-time listener. All right, let's get into. Speaking of Joe Longo as well, another big item of news this week was ASIC's stop order on Latrobe Financial. Can you walk us through what went on there?
Yeah, this is huge. So the industry, everyone's been talking about private credit. The regulator's been talking about private credit. I'm going to have to tiptoe a very fine line here. But essentially, ASIC, the corporate regulator, has put a stop order on Latrobe Financial and several other groups at a similar time.
Stop order on 2 of its products. 3 products now.
Yeah,
right.
So Latrobe, a stop order essentially means that ASIC is worried about the marketing or the design of that product and the audience it's being marketed to in a way. But because basically every fund, every investment has to have a target market determination, a TMD.
Yeah. And a lot of investors might not actually know what a TMD is because they tick the box to say they have. Because it's relatively, in the grand scheme of things, a TMD is relatively new. They've been out for a few years
after
now.
the Royal Commission.
But it's a target market determination saying, who this product is right for.
And how much, apparently reading the Fin today, how much it would be appropriate to invest into this product is a further extension of that?
Yeah, so I think where they overstepped the mark was saying it was appropriate for up to 50%
of all your assets, of a consumer's assets could go into one of these products. It was their assessment of their own product.
Yeah, whereas ASIC had that line drawn at 25%. So slight overstep there.
I mean, they're very arbitrary bands as well. I'm sure there's some sort of argument going on in the background. But basically, because of that, Latrobe can't accept money into its 12-month, 2-year term or its US private credit fund for 21 days. Basically, everything's on hold for 21 days.
That's significant.
Yeah. I logged into Colonial First State this morning and they said, I don't do that very often. They said the first thing that came up was you can't invest in these 2 Latrobe products at the moment due to a stop
they had
order.
like a little
pop-up. Yeah.
Banner.
And the challenge here is that, and it's always been the case, and it hasn't said anything about the quality of Latrobe. Like you go through the Fin, they're talking about their debts are quite low, but Latrobe is a non-bank lender. They're making loans to people and investors are investing into that pool of loans. There's securitization, there's all kinds of complexity and there's all kinds of liquidity mechanisms. But it's always been the case in financial service, in financial markets, where you have an illiquid asset, 30-year mortgages, 20-year mortgages, and a liquid product at the front end. Now, Latrobe, to my understanding, doesn't say it's daily liquid or anything. All these, you have to say 12 months in advance that you can't get your money back. So they're kind of overcoming some of that liquidity risk. But basically they're saying potentially your investors don't fully understand what they're investing into or the impacts of that if something bad were to go wrong. Is this becoming a systemic issue? I mean, it seems a bit late given Latrobe has 20 billion in assets under management. It feels like something you address as the sector's growing, not once Latrobe's for sale at the moment. So the fund manager is actually for sale on the market by its private equity owner. So it's kind of all the timing is a bit strange, but I understand ASIC's been working with lots of private credit managers asking for lots of information for months now.
Going to be more of this.
Yeah, constant. And it's not just in response to the Shield, which I think we've covered on all the podcasts at some point, but more in response to the massive boom in
private credit markets.
And this, what's called non-bank lending, used to be called shadow banking, shadow lending, because it's not done by a major bank. And it's, I don't know, without going too deep, we've probably gone pretty detailed on this as well. It's like part of it is the marketing of it. And then there's a thing that we see in Australia, which is, for some reason, I feel more comfortable in overseas credit. We were kind of talking about this before.
We were. Yeah. How that came up in the slight little plug for partner of the show, Term Plus.
Yeah. Also called Term, which I'm sure they're in conversations.
Also Term Plus. So we were previously also discussing how the naming conventions of these. I remember when the Latrobe products first kind of started to creep up on the register of investors. This was quite a while ago, and talking with investors saying, well, why should I invest with you guys when I can go out there and get this account and get 6%
guaranteed,
7% guaranteed, and it was like, wow, they're legitimately looking at it like a bank account.
You don't understand the risk. Yeah. And that's what ASIC's clearly worried about.
Yeah. So, but we were referencing Term Plus before because that is global.
Yeah.
So predominantly US, but it's global.
And I think in Australia, and this isn't saying that this is what Latrobe do or any particular managers or that this is a bad thing, but so much of the non-bank lending in Australia is all an ASIC reference. This is all construction and development. A lot of it is construction development finance because that's what the banks won't lend to. So that's why it's grown more. Whereas overseas, you get a lot more existing assets. You get a lot more. It's deeper, much broader, and that's why we've as a firm we felt more comfortable deploying overseas. That said, there's plenty of good private credit options in Australia.
Where's your private credit exposure?
Overseas.
Okay.
We don't really have any
predominantly
direct
US
in Australia. Yeah, mainly US. I mean, it dominates over there. But then commercial private credit in the US is, I think, $1 trillion. Like, it's ridiculous size compared to Australia.
It's much more mature too.
Yeah, and different. You're talking about different firms. You're talking about $200 million buildings, not $10 million buildings. It's always about size in the comparison. But I think it's these naming conventions. I'm pretty sure they were just called mortgage funds back in the day, but there were what happened to managed funds that were managing mortgages. People wanted their money out when the global financial crisis hit. They couldn't obviously foreclose on loans and get those loans repaid because they're 30-year mortgages. So basically they had to lock the fund from redemptions and dribble it out or continue to allow those loans to service. And that's always the risk with putting illiquid assets in a liquid-ish structure, and then how it's being marketed. So when term came into the name, that's what ASIC's wary of. Is
it's taken them a while.
Everyone thinks it's a term deposit. I can't remember when it changed. It would have been 10 years ago.
At least.
Yeah.
I remember having these conversations when I was a BDM when I was still living in Sydney.
Yeah.
I've been in Melbourne for about 11 years now.
So I mean, it's like that was big news on Friday. Like to see that pop up in the Fin Review, and then I get the ASIC kind of releases as well. It was like, whoa, that's huge. Like there's going to be real change occurring in private credit, and we talk to a lot of groups, and it's all about transparency. It's all about being able to see the bottom of the end of your loan, being not necessarily that you need to be able to analyze it, but being offered that kind of detail so you know where your money's going, like anything else. And diversification.
And I know talking to a lot of people in that space as well, they're all talking about the quality of your manager there and do they have workout experience.
Yeah, exactly.
So when if they do go wrong, have they been there before? Have they been able to work with that situation to get the best outcome for investors?
Like, do you want ex-bankers or do you want ex-property people? It's kind of, you have to get the right mix. If you got any complaints about what Mitch and I have said, just send them to Owen.
I'll give you his mobile number after this.
He gets my email every week, as you probably know by context.
Yeah, right.
I think it's important to cover it, but it's also important not to pass judgment too much.
Yeah, absolutely.
Before we know.
But it's just, I think it's an area where we are absolutely going to be seeing more headlines.
Yeah.
It's just something that, you need, like any investment, you need to do your work, do your own research, or,
And there's groups like this that just get massive, cultural followings. Sponsor of a footy club, you just get this loyalty that builds out of it. And there's other much smaller groups in Latrobe that do very similar things, and at a lower scale. So there's always a bit of buyer beware, but inform yourself as much as you can.
So we've spent way too much time on that one. But so just to whip around some more news this week, we've got Transurban gearing up to buy some toll roads in New Zealand. So first major kind of acquisition in some time. It's really starting to position for like a bit of a strategic bolt-on there. So
they haven't done. All I've known. I don't mind. We like Transurban within like a real assets exposure, but basically every deal they've done in the last 10 years has been an expansion of we'll do this and we'll add an extra lane. So
we'll do the
distributor. We'll buy something out of receivership. It's never a real strategic.
This is more strategic acquisition, and with the potential, or the market's hoping to see the potential for it to actually reignite actual growth.
Yeah. Not just forcing more cars onto the road. I mean, I got stuck on CityLink for 2 hours the other night getting home from the airport.
Dear. Do you drive and park at the airport and pay?
No, I was in an Uber.
You're in an Uber. I was going to say, you look like a premium parking man.
I mean, depends. Airport. I've been cutting it really fine. So sometimes it's like I'll be leaving it, 40 minutes before I have to board, and traffic
from your house.
Yeah, down Bell Street can be shocking. And in that case, you jump out. I'm like, whatever it is, I'm getting it just to get in, and then run to the flight.
Whereabouts are you?
Ivanhoe, Eaglemont, Northeast.
I was going to say, if I had to guess, I would have probably said like Hampton or something like that.
Come on. It's the Shackets, isn't it?
All right. Another big bit of news, Reese. They you might have seen the share price have a significant pop. This week they've announced a share buyback. And I can't remember the actual price points, but there was a minimum and a maximum that they would be paying for the shares, and of course the share price popped and sat neatly right in the middle of those two prices.
And they had a struggle, like they had been struggling, and they had a bit of a downgrade.
Well, it was probably the most talked about earnings call of the entire reporting season. The quite visibly emotional earnings call from the CEO, from the Wilson family, of course, who have owned a significant stake in Reese and operated Reese for many, many, many years, and that was all over their US expansion, which not going as swimmingly.
In hindsight, I mean, everyone always tells you that, don't they? It's like when you go and expand globally, it's always like, but CSL's done well, like in the ASX. But then your analysts and all the shareholders want you to keep looking for growth. Otherwise, what's the point? And then you do it.
There's only so many ads. There's only so many ads you can put on the block.
Yeah, I know. It's like you could never get it. Like, you're damned if you do, you're damned if you don't. At least he was wearing it. Like, he's wearing it.
Oh, absolutely.
And like he wants it to be a success as well.
Yeah. What else have you got for us, Drew?
Usually, I think it's a good sign, but not always the perfect sign. When someone's going out buying their own stock.
Yeah.
Like, sometimes it's like I can't remember what's the word.
Well, it's all about, is it a good capital allocation decision or not?
Yeah.
Really, here.
It's not by default a good sign. Sometimes they're doing it because they want to improve sentiment for their company.
Is it part of the narrative?
Yeah. But then Buffett set it up like, our intrinsic value is below. But I think he'd probably get a better intrinsic value on his 400 investments, and we kind of won. Who knows?
Yeah. What else? Anything else you saw in the news this week?
Massive open like this. I think we covered it last week, but the circular AI economy.
Yeah.
So OpenAI, Nvidia has agreed to invest $100 billion US into OpenAI, but then OpenAI has agreed with Oracle to buy $300 billion.
Just a bloody merry-go-round, isn't it?
But then Oracle's buying Nvidia chips. So it's the same. It's like, there's an episode of Bluey. You watch Bluey?
Yeah.
There's this episode of Bluey where they're $5 at the market.
At the market. Yeah. It kept on getting handed to one vendor to the next.
All the way around.
From the Tooth Fairy.
And they're all trading at 60 times earnings. So,
and spoiler alert, Bluey ends up buying a toffee apple. And bites right at the end, bites into the toffee apple and loses another tooth.
Exactly, and gets another $5. It sounds like AI. You just create money. It's fun. It's super interesting, and it's actually like, is it that much different to other industries? I think it's like everyone's been like kicking this a fair bit this week because of the dollar amounts, but there's other industries where you're buying stuff from someone and then you're employing them to do something like it. I think it's pretty normal, particularly when you're the biggest companies in the world. But it just shows AI is going nowhere.
That's your judgment. We are
looking at ways to pivot. So we're looking at
let's go back to that. When you say AI is going nowhere, please extrapolate.
There's so much runway and so much investment that's going to occur in these sectors. And yes, some of it's priced into share prices of certain companies at the moment, but there's probably going to be heaps. Will be heaps of divergence. So we're looking more at like the cybersecurity side at the moment. I was joking about, I'm not sure if you see the Instagram reels that are like Microsoft Copilot. If it was a person, and like that. Microsoft Excel, and it's just screaming at people using it, telling them they're doing it wrong because there's all the things that come up. And there's certain, like Apple and Microsoft are kind of known that they're like the AI isn't great yet. Certain things are incredible, but it's not great. Like there's going to be winners and losers in some of the big companies. I'm not saying it's going to be them, but some of them, there's going to be all different types of winners and losers. Making sure you're picking the right areas, the right sectors.
So you're picking cybersecurity.
Yes, I think if you're buying now, it's hard to continue to double down just on Nvidia, Amazon.
What about
you're just buying the hyperscalers, basically?
The infrastructure?
You mean like the data center owners or the things going into the data centers?
That and I know I've spoken to a lot of infrastructure investors recently.
I mean
buying energy,
yeah.
Also like the picks and shovels, etc. Around the edges. I think it's Global X, sponsor of the show. They do have They have essentially a picks and shovel kind of AI ETF. But as well, like infrastructure plays, I know every single infrastructure investor that I have spoken to is incredibly bullish on energy
demand. Yeah,
yeah.
And we're 100%.
And so they sit there and say, well, you can try and pick the winner of the AI arms race, or you can just sit back and say they're going to consume an absolute
truckload of
energy doing it. And so what would you rather?
And you had KKR and CPP, Canadian Pension Board, bought into Sempra Energy, like a big US energy provider overnight. And
I didn't see that.
It was like $10 billion or something. I'm doing our daily updates this week, so that's why I'm a bit more on top of it than usual. We are actually, so I've tasked our asset consultants to look at the private infrastructure opportunities. So what you tend to look for is there's core infrastructure, airports, toll roads. That's easy to get in an ETF. But when you start to go niche, like data centers, like energy trend, like all those sort of areas, you need to be a bit more core. They call it core plus, I guess. So we're looking at private infrastructure, including data centers, energy provision, all that sort of.
How do you get access to that?
A lot of them are going to be semi-liquid managed funds. Is
when you say semi-liquid, what?
Monthly? Yeah, if you go into ClearBridge is one we've used. If you go into iShares, there's a couple of Global X. It's all liquid. It's all traded on the ASX. These are monthly liquidity, so you can put a redemption in each month. But similar to a mortgage fund, you're buying unlisted assets. So if everyone ran to the door at the same time, they'd freeze it for a year or two. And you'd have to hold off.
So you've got to be prepared to be,
except some illiquidity,
a long-term investor in that.
But that opens up asset classes that aren't on share markets as well.
I've got a few questions.
Yeah, we tend to forget these some weeks.
Yeah,
I feel like the audience might appreciate it.
Yeah, I'd like to get into them. And so I do actually have one. This is based off a conversation I had this morning. And I want to get your take on employee share schemes. And also, this is not in the list of questions.
That's right.
Hence the look
I'm
on
trying
your
to find
face.
my dad joke after I had two absolute battlers the last couple of weeks. So.
It was pretty ordinary. I even sent you one yesterday, which I think is probably a bit too
inappropriate.
So anyway, so I was having a conversation this morning with someone, and their son works for a relatively well-known retailer and gets the option to actually purchase shares as part of their standard kind of salary. Like every single month, X percent of the salary can go to be buying shares at a discount of the retailer. And because of this, his share portfolio is 90% this one company. A good company, but 90%.
I mean, it's all in the eyes of a beholder.
Yeah. So, but it's actually not that uncommon. I speak to a lot of people who fly in, fly out workers in the mines, and they have been, working for BHP, et cetera, or Rio or whatnot, and they've built up a huge chunk in just
one or two companies.
in that one company that they've worked for 20 years.
Yeah.
How do you deal with that?
I mean, there's different ways, and a lot of the time you see it not as relevant anymore, but like tech companies, they, handing out equity like it's paper, and just a lot of times it is paper. I mean, it's got to come down to the objectives of that person at their age as well.
No sane financial advisor would sit there and go, yes, have 70, 80% of your net wealth and your occupation.
Never. The
etc.
first thing we do is provide, and we've tried to help in different ways. One of the things, if you go to a massive investment bank, if you got $20 million worth, they might lend you against that
believe
stock.
it or not, I've not been.
They might lend against that stock so you can diversify, so you don't have to sell it. But obviously, they make money on the loan as well, so in their interest to do that. But generally, no. And if you think about this person, you're investing, but two, you're investing in one company, and the future of that company, even Amazon and Apple have struggled at different points. So you might be comfortable if you're in those, but they've also had periods where they've fallen 60 or 70%. Particularly for young people, it's more like, I think you can invest and do it better by taking control of where it's going. And maybe in this case, particularly maybe the first few times it's great, you get some sort of equity built up. But once it becomes a real reasonable amount of money, you're going to start to want to do other things.
I was going to say as well, this is not a fly-by-night company. This is, let's just say, the largest shoe manufacturer in the entire world, without saying who it is. So
leaning.
So, well, I presume it's the largest. Does that change things? And because you're on the ground, you're working in that company, you are very close to it.
Who can be close to it? The only person that can be close to that company is the CEO or the chairman. Even then, they're at the whim of what the analysts say about it. I'm like, I'd always be, you would almost, you can't guarantee it, but you'd be better off buying a diversified, if you want to invest, buying a diversified, and instead of automatically buying those shares, automatically buying a number of ETFs and reinvesting it as that pay comes in, which maybe it helps, but then this company could be down 70% in the last few years and have challenged prospects. And then if you leave, you're going to hold on to the shares. I think it becomes, we tend to look at it when it's 40% of a $3 million portfolio. And that one is incredibly simple. You want retirement, you want consistency of income, you want resilience, you don't want to be reliant on one company. It's very simple to sell it then. This is a bit more complicated. Could be that if you've got enough savings and you can actually start complementing that on the side, maybe it's time to pause that, because if it's optional, and you start building up the portfolio around it. So you're still saving, you're still investing, if that's a bit of a non-answer. But I'd say, yeah, investing good, concentration risk bad.
Well summed up. All right, I've got another question here. This is from Kaiser Soze.
From Reservoir Dogs?
No,
Reservoir
that's
Dogs?
from...
Oh, damn it. Is that from...
I've just gone blank. Usual Suspects.
Oh, yeah. Close.
Yeah. Was it Kevin Spacey?
Yeah.
Yeah. Now, this question
I hope so, I'm not sure.
relates to ETFs and how those flows affect companies on the market.
Yeah.
Do ETF flows actually push up the prices? So he's using Commonwealth Bank as an example. Say he's buying VAS and 10% of every dollar he puts into VAS is naturally flowing into Commonwealth Bank. Do these ETF flows push up prices?
Oh, it's a very big question and a very long-term question, and it has completely changed the industry as well. The ETFs are all market cap weighted, so if someone buys more of that ETF, they have to go and buy more of the company. But there's also people selling at the same time.
Yeah, so there's lots of levels of liquidity when you're looking, especially at a really big ETF like VAS. If you're putting in $1, it's not necessarily always going. You could be selling. Someone else is selling, and you're just crossing with another investor.
Yeah,
it has to be pretty big movements for it to actually force the ETF into purchasing.
On a day-to-day basis, ETFs in large cap indices aren't moving,
and they're
the
not
market on the companies.
They're not setting prices.
No. And it's the incremental buyer as well. If you go and look at the biggest companies in the world, the biggest shareholders in those companies are Vanguard, State Street, all their biggest ETF providers. But then they're 3 or 4% of the shareholding of the company. So they may be big, but they're not moving the market on a daily basis. And that's the issue. That's one of the things to watch with ETFs, is that there were certain ones, I think the hybrid one back in the in the pandemic because the hybrid market is only a couple hundred million from memory, and the ETF, or a couple of billion, the ETF's a couple hundred million.
Well, it's got to be a lot smaller soon.
Yeah, exactly. But the movement in the ETF was actually impacting the market for the volume within the hybrid market, but that's on a very small scale. That's like a couple of billion to a couple hundred million. But on big asset classes, it doesn't have an impact. But broadly, like if you watch, I'd say the growth of ETFs and the incremental change from active managed or mutual funds in the US into passive has definitely driven a part of the concentration that's occurred. Not necessarily just the share price increases, but because we've seen earnings go up for those companies too. But the concentration has partly been driven by that switch from active to passive.
I wish I knew the numbers, but I would still say the managed fund industry is still
much bigger,
dramatically bigger here in Australia.
And overseas.
Yeah, ETFs are all the talking points right now. Like everyone's talking ETFs, and that's like when I was over at Futureproof, for example, every second stall was an ETF.
Yeah,
every second stall was one. Down to South Korean defense ETFs. Like it was very, very niche.
So there'd be more ETFs than there are stocks.
Absolutely. And so, but still here in Australia, the managed fund area, active managed funds still dominate as far as the actual dollar value, the size.
Yeah.
And so they're the ones setting the prices.
Yeah, and I think, and you could go through, there's economist articles, there's all like these detailed articles about active versus passive, and if we all turn passive, does that remove active? Like all these kind of existential crises. Day to day, it doesn't have an influence.
Well, then you do have people like Steve Johnson from Forager, Luke Larrative from Seneca, who have openly say, shout out to the Dome, not a podcast goes by where he doesn't get a mention. He's living rent free, for better or worse. So they're playing around in those spaces as well, where some part of their investment strategy is looking at companies that can become part of an index.
Yeah, and then you just buy it before,
because they know that there's going to be a lot of index tracking funds, plus ETFs, plus your super funds that essentially now, tracking the 300 that are going to be buying into it.
But I think there's been bigger trends impacting or driving the concentration and the growth in those companies. One was Your Future, Your Super coming into the industry fund sector, which meant active management in equities was one, costly, and two, risked underperformance, which meant most of them have just gone back to a more index
hugging
approach.
The ASX 300,
and then spent more fees on their unlisted assets to try and get diversification there. Because if they underperform the index, they have to stop taking members essentially, or pause taking members. So that's a bigger trend I think that's driven in recent years. But I wouldn't worry about day to day movements in it. I can probably track down one of those articles that talks about the different existential views on ETFs and passive investing.
I think it's one of those questions where a lot of people have very different
gold or crypto.
They have very, very, and some people have very strong views.
Yeah. Very. I'm always both, and I think you guys are very similar. Where passive, pick your beta or your market index, and then in retirement particularly, start looking for diversification because we don't want to be relying on just a couple of companies for our income and our growth.
Did you have any questions that you picked out?
I did bring a few out. I think I had to reference and touch on one of them.
There's a couple of really, really long ones.
Yeah,
but I just...
We'll go through one of them.
I'm going to have to probably get Monique to...
Don't catch the full enough.
Did you get...
Shorten it.
I did get the don't catch a full
Grisabella,
enough.
I have to fix this one too. I often get reminded I get things wrong. I said Charter Hall Long Whale rate was $5.80. I meant like $4.80. Sometimes I just throw numbers out there.
Really? No.
But the message
close enough's good enough.
Yeah, there was never been, it might have been, I'm not sure. But 466, what she said about 470. The message there was that it's trading very close to its NTA.
Can you actually read that question out so people know what it was?
Drew referenced, it's not a question, it's a statement. It's a two-parter. Drew referenced Charter Hall Long Whale REIT. So CLW on your show at $5.80. I can find no evidence of that price. Best price ASX past 12 months is $4.66. No other ASX chart hall product comes in close to $5.80. What company code were you referring to, or were you referencing another company? I was referencing the wrong price, but the message there was about the net tangible asset value close to matching the share price at the moment, meaning the discount had disappeared.
Never be afraid to be wrong on the internet, Drew.
Yeah, never be afraid. Just check out my YouTube comments. We've got a retirement podcast coming up where we go through mean tweets. Yeah. Mom taught, for all those at home, Mon taught me that when I laugh, I have to do this. Okay. Thanks, Mon.
So I've gotten some of my best podcast guests from being wrong on the internet.
Yeah.
I remember I wrote
because a CEO or an IR company will reach out.
They always reach out, so never be afraid.
Yeah, never be afraid.
Just lob it out there.
Make it up.
No. For example, I got Cam McIntyre from Car Group because we wrote an article and we called it...
You say we or you?
Well, to be fair, it wasn't me that wrote the article, but it was we put car sales in the headline and they just rebranded to Car Group or recently-ish. And so Investor Relations reached out to me and I said, well, whilst you're here...
Yeah, let's jump on a call.
Let's get him in.
Give us an earnings update.
And now I would love to get Cam back in because he's now the incoming CEO of realestate.com.
Oh, nice.
REA Group. So please reach out
for an interview.
Reach out for me to correct that.
There was a good one there was, can you do a segment on FMG, similar to what we did to Endeavour?
Yeah, so did you guys do that on Ticker? Did you pull up Ticker?
We did pull up Ticker.
Yeah.
I think this would be a good one, and I think maybe we can cover it next week. I don't know.
That was another thing that I need to talk to you about locking in that next week.
Yeah,
so Owen's still away.
Of course, that's why he needs to. Let's be honest.
To be fair, he's actually going to be in Sydney recording some content.
Yeah.
So,
but I think when you do FMG, so Fortescue Metals, you can't just do it on its own. You kind of have to compare it to Rio. You have to compare. I think this is one where you have to compare it to something very similar.
Well, it's pretty much almost all stocks, yes.
In Endeavour, what are you going to compare that to?
Yeah, right.
Car, REA Group.
Very good.
These are ones where you've got a very comparable business with similar revenue, similar product, similar everything. And it could be a this versus that question. We did say EDV's a dog. I think the share price went up the week after, but we're in for the long term.
All right. So are you locking that in for next week then?
Yeah, let's do it.
Okay, job done.
Get into the detail.
Alrighty. So anything else, Drew, before we get into the dad joke?
There was one question that was about borrowing against shares.
I did see that. Yeah,
margin lending.
That's don't catch a falling knife.
Yeah.
Has said, can you talk through borrowing against assets like shares and crypto? I have a decent portfolio and don't intend to sell to facilitate buying an investment property. My question is more about the value of assets you can borrow against as a first-time borrower.
And I think, you can't, in investments, unless you have $20 million in a stock, no one's going to lend you money secured by that stock by itself. You can use margin loans, which people have used in the past, and that allows you they take your shares as security, but they'll only give you a maximum LVR of something like 60 to 70%, if that makes sense. Not that, I don't do margin lending. So I think that's one area, but I don't think this gives the outcome, which is you want to lend against your shares to then invest into a property on the side. So you're more likely, the interesting thing is, and we talk about this all the time, you can almost now get a 5% deposit and leverage your money 20 times to buy into property. You can't do that with shares.
I sold a lot of pretty much all my direct share portfolio when I bought a house. Yeah.
What people tend to do is the debt recycling, don't they?
I sold RPM.
Yeah. It's probably worth more than the house now. But what people usually do is sell it, go buy the property, build some equity in it by paying off that mortgage quicker or hoping the price goes up, and then use that equity to then reinvest in those shares again. Because you're doing, Paul Clitheroe would say, it's not shares or property. As long as you're investing, it's a good thing.
Shout out to Paul. Good bloke.
Hopefully I said that right. If not, call me. We'll go and we'll do an episode.
Correct us, Paul. That's probably still if you look at our episodes on YouTube and podcast downloads, I think Paul, the episode Owen did with Paul, by a country mile.
Yeah.
People love the man.
Bill Mitchell did well for Owen and I too.
Really? Yeah. I've missed that one.
Founder of MMT.
Okay. Yeah. All right. I've actually just had someone call in from Port Douglas with a question. Got a bit of time on his hands. Can you provide an update on GGUS and why is Drew's portfolio lagging?
It's not lagging.
That is a live request from Port Douglas.
He might have sent that late though. So GGUS is the 2.5 times leveraged S&P 500 ETF. Yeah. He is hoping, that takes him over the line in our portfolios. I've been closing the gap really quickly until last night. So basically he's taken
Tesla pull you back again.
Yeah, he's taken more risk through his one stock holding that has gone up 52% in RPM Global. And that is the one, that deal's, who knows. I'm not going to comment on that. But it's now 16.33 Owen, 14.88 Derrimouth, everything, and Dizzy Rascals are
they're lagging.
Yeah, left behind.
When does this competition finish?
31 December, or the end of the year. And then we're going to do another portfolio. But all of them are above the ASX 200, which I think is a positive.
Is that an appropriate benchmark?
And here's, I don't know, the S&P 500. All of us, but Dizzy Rascals is above that.
I would suggest maybe benchmarking against something like
the NASDAQ.
Well, you're all pretty diversified.
Pro Medicus.
It's maybe something like a all growth portfolio or something like that.
He's got a bit of a problem though. I've got leverage by holding Microsoft and Nvidia and Tesla, but then he's diversified it, good or bad, and he's got FANG and GGUS, which is basically leveraged FANG.
He's doubling down.
Yeah, doubling, but he's still not getting the leverage that he wants because you're not getting that single company leverage. Like gold miners are up 110%, gold price up 30%. That's what I'm going for. Coming out strong. Just need Elon. Elon to buy $1 trillion worth of shares and we'll be fine.
Well, he's good for it, isn't he?
Yeah, definitely. Leverage Twitter.
Let's get to your dad joke, Chris. I need to be on a phone call in literally 1 minute.
Okay, I've been working on this one. I was pretty bad the last couple for when you hear that on the Australian Retirement Podcast. I'm very sorry. Why did the Scarecrow win an award? He was outstanding in his field.
There we go.
Right. I think it's about delivery for that one.
Like most of them, to be fair. Very good. Drew, thanks for popping in, mate. Next week, we'll be doing it remote because all of this gear will be up in Sydney for recording. Yeah, so amazing. I will catch you next week, and we'll have a lot more news next week as well because this week, a bit of a condensed week being a public holiday down here in Melbourne on Friday. So we
go Lions.
Yeah, I don't want Geelong to win.
No.
I can't watch that. Very good. All right, Drew. Good to catch up, mate, and we'll catch you next week.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.